Hi, welcome to Main Street Macro. I'm Neela Richardson, and this week the Fed will meet again to decide whether or not to raise benchmark rates that affect borrowing costs across Main Street and for larger firms. Now, we've seen interest rates go from rock bottom levels last year to over 5%. So, this is a really big increase in a very short amount of time. And economists are really mixed on whether the Fed is going to hike again or take a time out and pause and see what the effect of all these rate increases are on the economy. But in my opinion, it's as important to understand why they might make the decision that they make, whether even more important than the decision itself. Here are three factors that the Fed is going to be looking at. The first, are consumers feeling the strain? Are they feeling the strain of all of these rate increases? And there's some really interesting data here showing that consumers are still spending at strong levels, at least according to the latest data. And that's good news for the Fed because consumers are 70% of the economy. But still, there's some caution that applies here. Last week, we saw that the consumers are borrowing more. In fact, they're borrowing at the fastest pace since November of last year. They're also saving less. And all of this borrowing is at higher interest rates. So consumer spending could slow down even significantly in the second half of the year. The second factor that's going to go into the Fed interest rate decision this week is home prices and whether housing inflation is still going to accelerate. Now, this housing inflation is actually 40% of the metrics that the Fed is looking at in terms of inflation. And though we saw home prices actually decelerate at some parts of this year, they're starting to pick up again. And moreover, for renters, we actually see rental prices accelerating sharply from last year. They're up almost 9%. That's really, really high. And so it's likely that housing inflation is still with us even into the second year. That's going to second half of the year, and that's going to factor into the Fed rate decision. Now, the third factor that the Fed is going to be watching is what companies are going to do in response to higher labor costs. Now, here we might see some good news because labor costs are coming down. Our own data here at ADP shows that pay growth is starting to decelerate. And that might mean that companies don't have to raise prices to keep up with fast growing wage prices. So lots going into this week's Fed decision. It's a complex economy. And where they come out in terms of the consumer, house prices, and labor costs will determine the future of rate hikes this year and into next. Thanks for watching the Main Street Macro. For more information on the week ahead, please go to adpri.org.